السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
The inside bar pattern is one of the most common candlesticks you will find on your charts. The inside bar is a simple yet powerful candlestick pattern. It can help you better time your trade entries with lower risk. And the best part, once you learn to identify this pattern, then you will very quickly see it everywhere. You will see it in many different markets and in all your different time frames. However, just because the inside bar forms often and can be easily identified does not mean you should be using it or trading it. So in this video, we'll go through exactly what the inside bar is and how we can use it successfully in our trading. What exactly is an inside bar pattern? The inside bar pattern is a candlestick pattern where the price forms completely within the previous candlestick. So, for an inside bar to be considered valid, both the high and the low of the candlestick needs to be completely inside the previous candle's range. Most often or not, traders have this confusion around the wicks or shadows of the candlesticks. To clear this up from the start, the inside bar takes into account the candlestick's shadows or the wicks also. This means that the high and the low, including the wicks of the inside bar candle, must be within the high and the low of the previous candlestick. To simplify this even further, inside bar must have a high that is lower than the previous candle's high, and it should have a low that is higher than the previous candle's low, including the wicks. However, not all inside bars are created equal. There are different types of inside bar patterns formed in the market. Let us take a look at a few of these. The first type is an inside bar with a small range. So this is a standard inside bar where the range of the candle is small and it is covered by the prior candle or the previous candle. Now this tells you that there is an indecision or low volatility in the market. We will talk about this further in this video. The second type is the inside bar with a large range. Now you can have an inside bar with a large range. So this is still an inside bar as the range of the candle is covered by the prior candle or the previous candle. But in this case, you will notice that the range of the inside bar is too large. Now, depending upon the close of the inside bar, this could either represent an indecision in the market or a reversal in the market. Now let's see an example each for the long range candles of these types. As you can see, in the first category, there is a large inside bar with bullish close which shows signs of bullish strength. Moving on to the second type, it is a large inside bar with a small real body which shows signs of indecision. So depending upon the range and the real body, the inside bar can either represent an indecision or a reversal in the market. Now the third type of inside bar is multiple inside bars. So in this case, you have multiple inside bars together. This is a powerful pattern because it tells you that there is a low volatility in the market. To briefly talk about volatility, low volatility is associated with weak participation from the market participants, or it can signify weak price movements, while a high volatility is associated with elevated interest from the market participants. And we know the market volatility is always changing. That is, it moves from a period of low volatility to a period of high volatility and vice versa. So when you see multiple inside bars together, it is a strong sign that the market is about to make a big move soon. Now the fourth type is the Hikake pattern, which is a variation of the inside bar. This is actually a must-know pattern for all the traders because this pattern helps you identify a false breakout from the inside bar pattern. Imagine this situation. You identified an inside bar and you are hoping that the market will go higher, or simply you have a bullish outlook. So you go long when the price breaks above the highs of the inside bar. But the next thing you know, the market does a 180-degree reversal and collapses lower, and you are now in deep loss. Now this is what we call a Hikake pattern, which is a false breakout pattern. Now there are two variants of the Hikake pattern. The first type is a bearish Hikake pattern, which actually actually entices the bulls or the buyers into buying and then trap them and make them hit their stop loss. The second one is the bullish Hikage pattern, which actually entices the bears or the sellers into shorting the market only to trap them and reverses the price against their position. Now the Hikage pattern can be traded the same way you trade an inside bar, which we will discuss as we move along this video. But this is a much more powerful strategy since the breakout traders get caught on the wrong side of the move and their stop loss would push the market in your favor if you take the right side of the trade. Now let us talk about the nature of an inside bar or the outlook of an inside bar in the market. The inside bar is actually an indecision candlestick pattern. The inside bar is formed because the price was not able to break either the high nor the low of the previous session or the previous candle. Now this shows us that, or this tells us that neither the bulls nor the bears were in control during the session. This is a very important information when used correctly. However, it is important you note where the inside bar is formed and in what type of market. So if an inside bar is formed in a strong trend, for example, a trend higher, then it could be signaling a quick pause before the price continues on with the trend. And if the inside bar is formed at a swing point or even at a major support or resistance area, then it could be signaling that the steam has run out of the current move and the reversal is about to play out, or simply the market is about to reverse. Because this is an indecision candlestick, it is very important to pay attention to where and how this pattern forms. Moving on, let us look at the best time frames to trade the inside bar candle. As I have mentioned earlier, you will be able to find this pattern on all your time frames from the 1 minute chart right through the monthly chart. However, just because you can find an inside bar on all your time frames does not make them all created equal, because inside bars formed on a higher time frame will hold more weight compared to inside bars formed on a smaller time frame. The reason for this is simple because of the time that goes into forming this pattern. So if price action is showing indecision and it cannot break the previous candlestick high or low on the 1 minute time frame, that shows us that for 1 minute the price was stuck. However, if we see that the price could not break higher or lower on the daily time frame and it formed an inside bar, then it shows that for a whole day neither the bulls nor the bears could gain control of the market. This leaves us with the conclusion that the higher time frame inside bar candle holds a much higher weightage than an inside bar on a shorter time frame. Well then, let's talk about the trading strategies. Now, there are many ways you can use the inside bar in your trading. You can use it to find new trades, and you can also use it to manage your trades. The three simplest and most common strategies to trade the inside bar are the inside bar breakout, the inside bar reversal, and the inside bar trend trading strategy. Let us start with trading the inside bar as a breakout. The first key to trading the inside bar as a breakout strategy is identifying a strong trend, either higher or lower. In this example, the price is in a strong trend lower, and because there is a strong trend, the inside bar represents a pause in the price action where some profit booking is being taken and the price is taking a breather. So when you are looking to enter with the inside bar breakout, you are looking to enter when the signal confirms itself. This happens when the price breaks the inside bar high or the low in the direction of the trend. In this particular example, we are looking to take a short entry when the signal confirms itself and breaks lower with the trend. Or simply, we are looking to enter when the price breaks below the previous candle low. But to be frank, I'm not a great admirer or a fan of the inside bar breakout strategy in particular. And it's simply because of the sheer number of false breakouts that this particular strategy can generate. Also, it is not a very smart move to trade an inside bar on a choppy range or consolidation because of its low probability trade. And why is it so? Because a range or a consolidation happens when the market is taking a breather or when the bulls or bears are in some form of indecision. So it does not make any sense to use an indecision candlestick to take a trade on a market where indecision exists. So personally, I would be well off using the other two strategies than the breakout. So moving on to trading the inside bar as a reversal. The key to inside bar reversal strategy is where the inside bar forms. To use the inside bar as a reversal, you need to see it formed at a swing high or a swing low depending on the market trend, and even at key price action levels or areas of values. And these levels are often the major support or resistance level. For example, the price approaches a support level, and we know that a support level is one where there can be higher chances for demand for the stock, or where the buyers will be willing to enter a position. And if an inside bar was formed at or near the support, then it could be an indication that the price is looking to make a reversal back higher, and we could get long when the price breaks back above the inside bar high. But that being said, I prefer to wait for the price to make a reversal move first and then form an inside bar as shown in this case. Now what is the benefit of this? By doing this, I get to know two very significant things. Number one, that the buyers are in control at this period as they manage to make the first wave of reversal from the support level. Number two is that there is a volatility contraction due to the formation of an inside bar, and if the buying pressure could continue further, then it will manage to break out the reversal candles high and move higher. This is exactly when you can enter a long position, that is, when the price breaks out of the inside bar. This particular approach will let you enter the trade as the price moves in your favor. But on the downside, there is a possibility of a false breakout due to a bearish Hikake pattern, as we have learned earlier. You can avoid this trap by taking on a more conservative approach. You can wait for the breakout candle to close and enter the very next candle if the breakout candle managed to close above the reversal candle high. Now again, in this scenario, you risk missing a big move, or sometimes it can lower your reward to risk potential. So clearly, there is no right or wrong answer to it. So you have to find a trade entry which suits you best. When it comes to the stop loss, you don't want to set it beyond the lows of the inside bar, as the general rule states. And why is this? Because we have already learned that there is a variation of the inside bar, which is the Hikake pattern. This means if you set a stop loss just below the lows of the inside bar, you could get stopped out prematurely on a bullish Hikake pattern. So a better way to set your stop loss is using the ATR indicator. That is, you can place the stop loss 1 ATR below the low of the inside bar in case of long entry trades. This will ensure that your trade has more breathing room. So if you want to know more about the ATR indicator, you can watch the video here. Now I will talk about setting the targets at the end of this video after we have discussed the next strategy. The third strategy is catching the trend. Previously, you have learned how inside bar allows you to catch reversals in the market. Now you will learn how to use it to identify trend trading opportunities. Now here's the main idea behind it. Let us reference with the use of a 20 moving average. In a strong uptrending market, the price is above the 20 moving average. So pullback in such a market will be shallow. So when the price stalls or stops after a pullback in form of an inside bar, let us say, you want to enter as soon as the price resumes the direction of the trend. Now here's how you can approach the trade when you are going long on the market. Now as we have mentioned, the price is in a strong trend, that is the price is above the 20 moving average. We have to wait for a pullback to occur. And if the pullback has occurred, we have to wait for an inside bar to form. And if the inside bar is also formed, then you can go long when the price breaks above the highs of the previous candle of the inside bar. Or you can wait for the confirmation. That is, wait for the breakout candle to close above the inside bar's previous candle's high, so as to avoid being trapped by the Hikake pattern. For this trend trading strategy, you can consider setting your stop loss 1 ATR away from the 20 moving average, since the market finds support at the 20 moving average. Now let us talk about setting targets for inside bar trades. Now your exits or targets depends on your goals. So you can either catch a swing or you can ride a trend. So if you intend to catch a swing, then you can exit your trades before the opposing pressure comes in. For example, if you are taken a reversal trade from the support and you are long on the market, then you want to exit your trade before the next resistance or the swing high. Now if you want to ride the trend, then you can trail the stop loss as the market moves in your favor. For example, if you have taken the trend trading approach, you can trail your stop loss using the 20 moving average, and when the price breaks below the 20 moving average, that is when you should exit the market. Now when trading the inside bar pattern, by entering above or below the breakout of the pattern using any of these strategies, I would recommend you to go with the small ranged inside bar breakouts. Now there are a few reasons as to why this is important. The first benefit is that you can place a very tighter stop loss. You can reference the low of the inside bar to set your stop loss as we have discussed, and the smaller the inside bar, the smaller the stop loss is. And with a smaller stop loss, you can put a larger position size and still keep your risk constant. The second benefit is that the price will move quickly in your favor. The market moves from a period of low volatility to a period of high volatility and vice versa. So if you trade a small ranged inside bar, it means the volatility is low and there is a very good chance that it could expand or break out in your favor. This means you could get a good reward to risk potential on your trade in a short period of time. I hope this makes sense to you. As a closing note, even if you find the inside bar on all your different time frames, the higher the time frame, the more weight the pattern holds. Because this is an indecision pattern, it is absolutely crucial as to where and how it is formed. So you need to look at and follow the price action that is formed around the inside bar to successfully start using them in real market conditions. And as always, don't forget to learn about the pattern in detail and backtest it so that you are comfortable while using it in the market.
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.